Welcome to the Deep Dive, your essential shortcut to understanding the complex world of finance. Today, we are tearing into the colossal Q3 2025 financial results from BlackRock. They just dropped on October 14th.
Yeah, and this deep dive is really necessary because, look, this isn't just your standard quarter, right? It's not just market moves. This period, Q3, it really captures the first big impact of BlackRock's, let's say, aggressive acquisition strategy. So we really need to separate the performance they earned, organically from the scale they essentially bought.
Right, that's exactly our mission here. We want to understand this dual engine. How did they actually get to $13.5 trillion in assets under management, AUM, and, pull in a staggering $205 billion in net flows? We need to unpack those headline figures.
Figure out what's organic, what's inorganic.
Exactly, and see where BlackRock is really planting its flag for the future.
Okay.
So let's start with just the sheer scale. It's kind of mind-boggling. As of September 30th, 2025, $13.5 trillion AUM, officially.
It's less a number and more like the GDP of a decent-sized country. It really speaks to their global dominance.
And inside that number?
Well, inside that $13.5 trillion, you've got two huge internal milestones, the iShares ETF business. That crossed $5 trillion AUM.
Wow. $5 trillion just in ETFs.
Just ETFs. And their cash management franchise, that one surpassed $1 trillion AUM. I mean, these are just monumental internal achievements, reflects decades of building scale.
And the money just keeps flowing in, doesn't it? Yeah. Total net inflows for the quarter, $205 billion.
Yeah, and crucially, $171 billion of that designated long-term net flows.
Meaning it's sticky money, right? Not just temporary parking.
Precisely. Clients committing durable capital. That's what you want to see.
And that kind of volume, it translates directly to revenue power.
Absolutely. Total revenue hit $6.509 billion in Q3. That's a 25% jump compared to Q3 last year, 2024.
25% year over year. Pretty strong.
Very strong. And if you zero in on their core fees, the base fees and securities lending revenue, that specific stream also jumped 25% year over year. And interestingly, it showed a solid 13% sequential increase just from Q2. So momentum there too.
Okay, so let's recap. Huge AUM, massive flows, 25% revenue growth. Everything looks fantastic on the surface. But here's the twist, the puzzle for you listening. The official number, the standard GAAP diluted earnings per share, $8.43, which is actually a 23% decrease year over year.
Right.
That sounds like a massive red flag, given everything else we just said. What are we missing here?
Well, what we're missing is essentially the price tag for their future growth.
Right.
The reason that GAAP number looks frankly depressed is because the firm is taking this colossal hit right now from non-cash acquisition-related expenses.
Okay. Like integration costs.
Exactly. Think of them as the big upfront, often one-time costs needed to digest these massive companies they've bought.
So if we adjust for those specific charges, what happens?
Then the picture completely flips. The adjusted diluted EPS was $11.55. Now, that's only up about 1% year over year, so modest growth.
But not down 23%.
Not down 23%. And the key insight is those costs, things like amortizing intangible assets, big retention bonuses paid out over time, they get excluded from that adjusted number. And that's why the adjusted operating income, which tells you how the core business is really doing, that actually increased 23% year over year.
Okay, that makes sense. So they're spending heavily now to integrate, and that's masking the underlying strength in the standard earnings figure.
You got it. They're paying the piper now for future gains.
That is the perfect segue then. Since we know the GAAP results are weighed down by these M&A costs, let's look at what they actually bought. This digestion process, the M&A, that seems like the real story of their scale this quarter. What were the biggest deals driving this inorganic piece?
Well, the most immediate one impacting Q3 was the acquisition of HPS Investment Partners. That closed right on July 1st, the start of the quarter.
HPS, the private credit giant.
Exactly. Huge player in private credit. And that deal instantly pumped in $165 billion of client AUM and about $118 billion of actual fee-paying AUM, just like that. And we also keep in mind the GIP deal, Global Infrastructure Management. That closed back in October 2024.
Right, so that's still inflating all the year-over-year comparisons.
Correct. It makes the year-over-year growth look even more dramatic because you're comparing against a pre-GIP BlackRock.
And these aren't, small bolt-on deals. This is BlackRock fundamentally buying its way aggressively into the high-margin alternative space, private credit, infrastructure.
Precisely. And you see the results immediately in the alternatives category numbers. Their alternatives client assets now that covers AUM, committed capital, the whole lot nearly doubled year over year.
Doubled.
Yeah, from $334 billion in Q3 24 to $663 billion in Q3 25. That's a massive strategic shift. And specifically, private credit AUM just exploded. It surged to almost $142 billion, and that's largely thanks to HPS, which is, focused heavily on direct lending.
And that instant scale, it must translate straight into that high margin revenue. That's the whole point, right? The long-term payoff.
It does. I mean, if you just tally up the fee contribution from GIP and HPS alone,
Yeah.
they added something like $215 million from GIP and $225 million from HPS. So what, $440 million combined?
Just from those two deals?
It's from those two, feeding into the investment, advisory, and securities lending fee line. That's compared to Q3 last year. But here's the really eye-popping number. Performance fees. The bonuses they get when these private funds hit certain return hurdles,
Yeah.
acquisitions drove those performance fees up. Wait for it, 449% sequentially. Quarter over quarter, Q3 versus Q2.
Wow, 449%. That shows the immediate juice you get from owning these high-fee, potentially high-return, illiquid assets.
Exactly. That's the allure of private markets right there in that number.
Okay, so that covers the big, expensive building blocks they bought. Now let's switch gears back to the business they actually built, the organic side. That's represented by that $205 billion total flow number. Where were clients actually putting new money to work organically?
Well, the absolute engine of flows, no question, was iShares ETFs. Pulled in a massive $153 billion in net inflows just in Q3.
$153 billion into ETFs alone. The CEO called it record demand.
He did. And the diversity within that is key. It wasn't just one thing. You had $53 billion flowing into core equity ETFs.
Okay, standard allocation stuff.
Right. Then $41 billion into fixed income ETFs.
Also core.
Then, and this caught some attention, $17 billion flowed into digital assets ETFs.
$17 billion into digital assets, like Bitcoin ETFs and similar.
Presumably, yeah. That kind of figure really confirms that institutional adoption is moving well beyond just talk. Real money flowing in.
Interesting. Okay, beyond the ETF juggernaut, where else did they see organic strength?
Cash management was also strong. Brought in $34 billion in net inflows. That's somewhat expected, with interest rates still relatively high. People parking cash.
Makes sense. And how about client types, retail versus institutional?
Retail clients were solid. They contributed about $10 billion in long-term net flows. Institutional clients, now they added a net long-term inflow of $8 billion overall. But that $8 billion figure kind of hides a really interesting churn happening underneath.
Okay, $8 billion net seems modest for institutional, given their scale. What's the churn? Are they shuffling money around internally?
That seems to be exactly what's happened. The data shows institutional active strategies pulled in an excellent $22 billion in net inflows.
$22 billion into active. Okay, strong demand there.
Very strong.
Yeah.
But that was partially offset because institutional index products saw a significant outflow, about $14.4 billion leaving.
Ah, so they're taking money out of index funds and putting it into active funds, potentially within BlackRock itself.
That's what it suggests, yeah. Large institutions seem to be maybe trimming their core index holdings, while simultaneously trusting BlackRock with new, probably more complex active mandates. And you can see why they might trust them. Look at the performance numbers BlackRock shared. Their systematic active equity AUM. 90% of those assets beat their benchmark over the last year.
90% over 1 year. That's impressive.
And even better, over 5 years. 94% beat the benchmark. When you deliver active results like that, clients tend to reward you with more assets, even if they pull from index elsewhere.
Good point. Can't argue with performance. Geographically, was this inflow story pretty even across the globe?
No, not really. The
No.
Americas definitely led the charge, contributed $110 billion in total net flows.
Okay, lion's share there.
Yeah. EMEA was second, respectable $64 billion. But Asia-Pacific, APAC, was the outlier. Actually reported a small negative total net flow, about $3 billion out for the quarter.
Interesting regional dynamic there. Okay, let's loop back then and connect this growth story, both organic and inorganic, back to the expense side. We know overall expenses are high because of M&A, but what about BlackRock's technology platform, Aladdin? That's supposed to be a high-margin growth driver, right? How's that part of the story holding up?
Aladdin and related tech services are still performing very well. Technology services and subscription revenue hit $515 million. That's up 28% year over year.
28% growth in tech revenue. Solid.
Yeah, and the key metric they track, annual contract value, or ACV, That also increased 29% year over year. That's great.
Okay, 29% ACV growth. That sounds fantastic. But
Mhm.
how much of that was organic versus, bought through another deal?
That's the right question. A decent chunk of that growth was indeed bought. That ACV number includes about $65 million in Q3 revenue that came from the Precoin acquisition. Remember that one? Closed back in March 2025.
Ah, Precoin, the private markets data
Yep.
provider. Right.
Exactly. So if you strip out that Precoin contribution, the underlying organic ACV growth was still a healthy 13%.
Okay, 13% organic growth for Aladdin is still good, but it shows they're also using M&A to accelerate even their tech and data capabilities.
Absolutely. They're signing new clients organically, but also buying capabilities and client bases through deals like Precoin.
Which brings us back full circle to that surge in overall expenses we talked about, up 27% year over year. Where exactly is that cost concentrated? It can't just be tech M&A.
No, it's heavily concentrated in two main areas, and they link directly back to those huge GIP and HPS deals. First, people costs. Employee compensation and benefits spiked 33% year over year.
33% jump in comp. Wow.
Yeah, and that reflects the immediate cost of bringing all those GIP and HPS employees onto the books. But it also includes critically non-recurring retention-related deferred compensation.
Ah, the golden handcuffs to keep key talent from the acquired firms from leaving.
Precisely. You pay a premium to keep the experts who built those businesses. That's a big chunk of the increase.
Okay, that's the people cost. What's the other big piece?
The other side is that non-cash hit we mentioned earlier impacting GAAP earnings. It's the amortization and impairment of intangible assets. That line item increased by $164 million year over year.
And that's basically the accounting cost of the deals.
Pretty much. It reflects the accounting requirement to put a value on things like the acquired client relationships, the brand names, the technology platforms from HPS, GIP, and Precoin, put that value on the balance sheet, and then gradually write it down or amortize it over time. So long story short, the firm is taking the biggest hit from integration costs right now upfront, which explains why that headline GAAP earnings number looks so weak compared to the adjusted one.
Got it. So boiling it all down, what's the ultimate takeaway from this deep dive into BlackRock's Q3? It really seems like a story of two powerful forces working together.
I think that's right. On one hand, you have this remarkably robust organic flow engine, still firing on all cylinders, especially led by ETFs and cash management.
Billions pouring in organically.
Billions. But paired with that is this very aggressive and clearly expensive expansion into the high-fee, often illiquid world of private markets through huge acquisitions.
And that strategic push buying GIP and HPS, it really confirms BlackRock's long-term vision, doesn't it?
I believe so. I mean, the near-term pain on the GAAP earnings, those big retention bonuses, the massive amortization charges, that's just a price of admission. It's the cost required to bolt these enormous private market platforms onto their existing structure. They're taking the hit now to try and unify their unmatched public market distribution system with this new high-margin alternative capability. It's a long-term play.
Which leaves us, and you listening, with maybe this final provocative thought. BlackRock's massive push into private credit and infrastructure through deals like GIP and HPS, it fundamentally changes what the firm is, right? It's not just the king of index funds anymore.
Not by a long shot.
So what are the long-term implications for the entire financial industry? When the world's biggest asset manager merges these traditionally high-fee, siloed, illiquid private assets so aggressively with its massive global tech-driven public market platform, could this be the moment we start to see the world's public and private investment markets really begin to coalesce, maybe even consolidate, under a single dominant infrastructure provider?
A fascinating question. And potentially a bit scary for competitors.
Definitely food for thought. We'll leave it there for this deep dive.